Use covered calls to generate more income. Welcome back to the Retire with Peace podcast. As always, I'm your host, Dave Zaegel.
Welcome to the Retire with Peace podcast, the podcast where we help you create a fulfilling and stress-free retirement. Each week, we bring you expert advice, practical tips, and inspiring stories to help you plan and live your best retirement life. Whether you're nearing retirement or already enjoying your golden years, this podcast is here to support you every step of the way. Let's embark on this journey together and discover how to retire with peace.
Today, we're going to get a little more technical. Okay, maybe a lot more technical than we usually do, because I want to cover a topic that can really be helpful if you are willing to learn it. If you're not willing to learn it and still want to see this in action, reach out to us. We have CWOs for Hire, where we work with people on retirement and tax planning, and using covered calls is part of what helps the investment accounts continue to generate income over the long term. So we're talking about covered calls today, which is an option strategy. First, let's back up big picture, because you'll see and hear a lot of different things about options. First of all, covered calls are not new. They've been around likely since options were created, which was several decades ago. So nothing I'm saying today is something I've created or come up with out of some sort of genius thing. A covered call strategy is really probably the most basic options strategy you can use. And it's actually relatively easy to learn. We're not going to go over every single detail on which strike price to choose and time frame and all that stuff. We'll cover that a little bit. But when you hear the word options, you go on a Google search of using stock options, you'll see all sorts of stuff, and a lot of it's good. But you'll also see and hear a lot of things about options are so dangerous. Options are the devil. You should never touch options. It can ruin you. All this stuff. Good news. When you use blanket statements like that, they're generally not true. It's kind of like a standardized test. If the answer is, never or always, chances are those are not the correct answers. Sometimes they are, but most of the time, not the right answer. So when you see statements like never use options, they're awful, they're dangerous, that by definition is not true, because when you have an options trade, there are two sides to any options trade. Generally, one side will be the lower probability, more aggressive, higher return. So think of something that might get you a large return, but maybe only has, 20, 30% chance, maybe less, of actually being a winning trade. So you have that side, and then you have another side, which is the higher probability, lower return side. And that's what we're talking about today in this discussion. Neither side is necessarily good or bad, because even the lower probability, higher return might be serving a purpose. Maybe somebody is wanting to buy an option very cheaply to protect against the stock moving one way or another. So again, even the low probability stuff is not necessarily evil. It has to be viewed in the context of all your investment. What you should probably not be doing too much is using low probability, high payouts to try to buy a lottery ticket in case something works out well. Those trades are low probability for a reason. And we're not going to get into all the implied volatility and time value stuff. We're trying to keep this topic as simple as possible within the context of options trading. So with that being the background, let's get into what covered calls are and how they can be helpful. With a covered call, you have an ownership in stock that you already have existing. So let's use Apple. Everybody knows Apple. So let's say you own Apple and it is trading at $300 per share. Now, just to be clear, for all those of you who know options, I'm not actually going through an exact, here's what the options chain is. So I'm going to make up some numbers to give an example. So let's say you have Apple, $300 a share, and you own 100 shares of it. Because for this strategy, this works in 100 share blocks, and I'll explain why in a second. So let's say you own Apple 100 shares at a cost of $300 per share. That's what, in this example, what the Apple stock price is at the moment. So you have this stock, and you're going to hold it for a while because it's a good company. So in this strategy, it's important to have good, solid companies that you're going to be able to hold for the long term. So you've picked the stock. It's a good stock. Everything's going well with the company. It's steady. You're not worried about it going to zero tomorrow or anything close to it. And it's not to say there won't be ups and downs, but again, we're trying to just focus on good, solid companies. 100 shares, Apple stock, trading at $300 in this example. What you can do is sell somebody else the option to buy it from you at a higher price. So let's say you've got this at $300 right now, and you say, John, I will sell you this stock at $330 at some point in the future. So an options contract, they're going to have different expiration dates. In this example, we'll say a month from now, because that's pretty common with a covered call. You're not going to go way out into time. You're going to stick within a month or two, generally. So you're saying at any time in this example, in the next month, you can buy this stock from me for $330. And right now it's at $300. John, would you agree to that deal? Now, why would John do that? Why would he want to buy this at $330 at some point in a month when right now it's only worth $300? Well, from John's perspective, he doesn't have to risk as much. So maybe that option costs, and again, I'm making up numbers. So those that are either looking at options chains, don't quote me on the numbers. We're just doing an example. Let's say that option costs him $3. So now he can look at this and say, all right, this one option gives me the right to buy 100 shares. That's the way options work. You buy one option, gives you the right to 100 shares. So from John's perspective, I can buy this one option that gives me the ability to buy 100 shares of Apple if it goes from 300 to 330. And it only costs me $3 per share. So that $100 times the $3 per share, this trade only costs me $300. So if Apple does nothing or it goes down or just goes up slightly, John's out $300. He has capped his risk. However, let's say something amazing happens and Apple goes up to $360 over the next month. Cool. John's low probability bet has paid off, and he only had to risk $300 instead of buying 100 shares of Apple stock at $300, which would cost $30,000. He's able to take a small amount that is low probability of happening, not zero, but low probability of happening, and say, I'm only risking $300 because I bought this option for $3 a share for 100 shares. I'm only risking $300. If it goes above $333, that's his break even because it cost him $3 a share and he's buying it at $330. His break even is $330. So if it goes above that, now he has a gain. So that, I'm just giving that perspective from who's buying the option, because people might say, well, the price he's buying it at is higher than the price I own it for. Why would he do that? Well, because he can risk a little bit less money on what is a low probability trade. Again, that is not a trade I recommend doing all the time from John's perspective, because it is low probability. So what we are doing is the opposite. Remember, we are offering this to John. We have 100 shares of Apple stock. We are saying, John, I will give you the option to buy this from me at $330 per share at some time over the next month. John says yes. He immediately gives us $3 per share. So right off the bat, we have $300 in our account. There's no condition to that other than if it goes above $330 at some time over the next month, John has the right to buy it. But otherwise, that $300, that is cash in our account. So let's play this out. What happens if Apple goes down? Well, you collected the $300, the $3 share. And there's going to be ups and downs with that stock. So if it goes to 290, you still hold it. I mean, you can sell it at some point, but then you have to deal with the option as well. So this is something that we want to be able to hold and not worry about buying and selling all over the place. But it's essentially, if it stays below $330 per share over the next month, you still hold the stock. You collected $300, which in this case was about it was 1% of the $30,000 stock that you own. So for that month, you got to collect an extra 1% off your Apple stock, essentially for doing nothing. Your only risk, and it's not really a risk, but your risk is the opportunity cost of if it goes above 330, that is where you are capped in terms of a gain. So in that case, if it goes above 330, you get your 10% gain because it went from 300 to 330. That's a 10% gain. You would get that in a month. Plus you get the 1% in options premium that John got you. Not a bad month, 11%. I think that makes a year for a lot of years. So in this example, and again, don't quote the exact numbers because that $3 per share might not be exactly what it is on that $30 spread. But the point being, the big picture is that you're taking a stock that you're going to hold that you know is solid. So through all the ups and downs, you're not stressing out and trying to figure out, do I flip out of this, flip into this? You're holding this stock for the longer term. And along the way, every month or two, you're able to sell someone else the option to buy it from you at a higher price. Now, I say every month or two. In reality, it doesn't always work out to be that you get to do this once a month, every month for the entire year, and it works out 12 times a year perfectly. That's not how it happens. But a lot of times you can get maybe 7 to 8, 9, 10 in a good year of those occasions where you can do that. Generally, when the stocks are down, we are not as inclined to sell premium. Excuse me, I'm going to try not to use jargon. When stocks are down, we are generally not inclined to sell somebody the option to buy it from us because it might be likely to ramp back up higher and we don't want to get capped out on that gain. Conversely, when stocks are either flat or up a lot, those can be good times to sell somebody else the option because it has already had a nice run higher. It might continue to run higher, or it might have been flat and then run higher. But in either case, you can leave enough space between what the value is and where you sell it to where if it does move up a bit, you're not losing the stock. It's not being bought out from you. You can just be focused on collecting that additional premium along the way. So I hope that all made sense. I did my best not to get super duper technical and talk about implied volatility and the time value declining on the option, all that stuff. That's all out there on the internet to learn. And it's just not meant for this type of a podcast format in the short format. But I just want to give everybody the high level understanding of a good way, especially when we're talking about retirement planning, a good way to generate additional income that really isn't overly complex once you learn the basics. It takes some learning. And yes, it's important to really know what you're doing so you don't mess this up. But it's not something crazy or something that's never been tried. This is about the most boring, simple, income flow based option strategy there is. There's other ones out there, but this one is pretty simple. You own 100 shares of a solid company. You consistently sell people the option to buy it from you at a higher price, and you're just collecting income off that. Somewhat similar. It's not a dividend, but it's similar in concept to where you own the stock and you're able to collect some income simply from the ownership of the stock. If you don't feel comfortable with this, you don't know what you're doing, but you still want help, certainly reach out to us. We have CWOs for Hire, where we help with retirement and tax planning and all these investment and income strategies. Definitely give us a call if you need help. I hope that helps you retire with even more peace with an understanding that there is an option to use options to generate more income in your investment account.